All right. Today is Thursday, December 9th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. We have a lot to talk about, so let's not waste any more time. And here it is. In focus tonight. What else? Let's talk about the big number, the CPI, the Consumer Price Index, also known as the CPI, which perhaps will be one of the most important readings in CPI history and perhaps in stock market history. And the reason is it will influence the policy of the Fed. Now, before we dive into the details, let's talk about base effects, because this is how the criminals at the Fed and the Bureau of Labor Statistics will try, keyword try, to influence the CPI down and give you the illusion that inflation is peaking and it's over, all to prop the equities market higher. So what are base effects? And this is a disclaimer, by the way. This is simplification of what base effects are, because you're gonna hear comments saying, this is oversimplification, bro. Exactly. This is what we do in this channel, explaining the economy and the stock market the street way. So let's say that I have a horse manure business, right? I have a horse farm, a bunch of horses shitting all over the place, and I collect that shit and make fertilizer out of it. Now, let's say back last year, 2020, specifically October of 2020, I produced 10 tons of horse manure. Fast forward a year later, in October 2021, I produced 15 tons worth of horse manure. That is an increase of 50% year over year. Now, let's do November, for example. Last year, 2020, November 2020, let's say that I produced 11 tons worth of horse manure. And this year, last month, November 2021, I produced 15 tons worth of horse manure. So my production of horse manure month over month remains the same, exactly the same, at 15 tons. Yet the year over year increase is only 36%. What does that mean? If you're looking at base effects, you can say that my production went down. The growth in my production went down from 50% year over year to 36% year over year. And this is what the Fed and the BLS will attempt to do. And they will sell it out to us as, oh, you see, inflation went down. Meanwhile, it is exactly the same as it was last month. Now, let's say that I produced 16 tons last month. That means a growth of 45% year over year. Yet the Fed and the corrupt crooks looking at this, they will say, you know what? The production went down from 50% year over year to 45% year over year. These are the base impacts. Substitute horse manure with inflation, and they will say, oh, inflation went down by 5%. Yay, transitory is back, right? Bring back Mr. Transitory. And this is all crap, of course, because the production went higher month over month by 6.6%. Likewise, inflation could go higher month over month, but the base impacts could distort the reading, and they'll tell you, you know what? The CPI is flattening or down. Inflation is transitory. The Fed doesn't need to raise interest rates anymore, and therefore the stock market goes bananas. Now, this is what they're going to attempt to do in the morning. But the point of this illustration is we get a look at the month over month numbers, not the year over year. The base impacts mean nothing to me at all. I look month over month to spot whether this inflation is growing faster, slower, or neutral. And with that out of the way, here's the background. Economists are forecasting that the reading we're about to have tomorrow is the peak for inflation. And we know that economists have been wrong all along, so you take whatever they say with a grain of salt. We also got inflation readings from Mexico today, and it is the fastest and highest inflation in 21 years. And therefore, the bankers over in Mexico are now being more aggressive in their interest rates policies. Also this morning, we got inflation data from China, and the factory gate number actually moderated month over month. But the devil is always in the details, because food prices are surging out of whack in a stunning fashion. China's vegetable prices surged 30.6% in November as food costs soar. And it's not just vegetables, by the way. Pork, a staple in Chinese diets, remained well below the highs of last year, with a year-on-year decline of 32.7% in November. But pork prices rose 12.2% from October, so month over month, pork prices are rising higher again. Food prices are on the rise globally, according to the Food and Agriculture Organization of the United Nations. And the food price index is reaching highs we haven't seen since 2011. You gotta know this. Yes, the trick with the Pokemon variant could have worked, it might have worked already in reducing energy price inflation month over month. The problem is, if inflation is migrating from energy to food, and you and I know that rent prices are surging out of whack, and the CPI doesn't account for rents at all, and therefore we call it the CPI. Now, let's review the numbers from the last report because these items will be important to figure out whether inflation is rising month over month or not. In the last report, we're not going to look at the year over year readings because these are the base impacts. They're inflated. We know the story. I look at the month over month from September to October because this report was from last month. And I want to highlight any reading above 1% because these items with over 1% inflation month over month are where the concern primarily resides. Take, for example, food. Food prices were up over 1% month over month. Food at home, similar story. Cereals are rising higher, specifically breakfast cereal, went higher by 3.3% month over month. You can see that bread price is also higher. This is bread other than white, of course, went higher by more than 1.1% month over month. Bakery products, frozen bakery products, pies, etc., went higher over 3.7% month over month. Meats, across the board, the inflation is stunning in meat prices. All of these categories, meats, poultry, fish, eggs, veal, ground beef, experienced inflation over 1% month over month and double-digit inflation year over year. When we look at items like pork, bacon, sausages, all surging higher. We're not talking even year over year. We're talking month over month, over 2% apiece. Pork chops, frankfurters, even chicken, which was cheaper than beef, now is also rising higher 1% month over month. Frozen chicken also up 1.5% month over month. And these bastards are coming after ice cream too. Even ice cream. Come on, man. Come on, man. Well, when you combine the rise in prices for milk, eggs, and all the components of ice cream, it is no surprise that inflation went higher 2% month over month from September to October. And mind you, we have a lot of shrinkflation in the economy, so they're shrinking the packages for ice cream and other items. And even with that, prices continue to rise higher. Fresh fruits, bananas, oranges, lettuce up 1.5% month over month. Canned fruits, similar story. Frozen vegetables also up 1% month over month. Juices, frozen juices also rising higher month over month by over 1%. Coffee rising higher 1.7% month over month. My expectations are coffee prices will continue to rise higher month over month and year over year because coffee futures shot up higher. Even sugar is rising higher by 2.6% month over month. Butter 1.8% month over month. Peanut butter up 3.3% month over month. Other foods also 1.4% inflation month over month. How about snacks? Even snacks. You say, okay, don't eat meat because it's unhealthy. You might want to switch to something else. Well, the inflation in vegetable prices is even worse than meats. So what do we have now? Snacks? Even snacks are rising higher by 2% month over month. Spices, condiments, up 1.2% month over month. Condoms are okay. They're still cheap. Nobody uses them anymore. Unless you're buying the iCondom because it has the Apple logo on it. That's worth a premium, right? Anyways, olives, pickles also up 1.7%, sauces up 1.4%, baby food 2.6%. And when we talk about food at employee sites, because we have the reopenings from the D thing, right? Also up 1.8% month over month. And of course, the inflation is stunning when it comes to energy prices. When we talk about fuel oil, for example, up 10.5% month over month, propane, gasoline, all up dramatically. We're talking month over month, and of course, the readings year over year are stunning, and this is being reflected in utility prices, specifically gas. If you're heating your home, gas prices went higher by 6.5% month over month, and you wonder why the administration is panicking, and hence the release of the Pokemon variant. But anyways, when we look at the charts, energy prices will be the most important item here because if prices go down dramatically, then the reading of the CPI will also go down and we will have the biggest orgy in stock market history. And here it is. Crude oil prices, the WTI, went down. This is a monthly chart. In November, it went down dramatically. Here's the problem. The majority of the declines happened after November 26. So will that be reflected in the CPI reading or not? Who knows? Because it takes time. There is a lag of response between future prices and gasoline prices at the pump. When we look at natural gas, this is a monthly chart, of course. The reading should come down. So natural gas prices, heating prices, month over month should go down because we have a comfortable decline here in natural gas prices. Now, will this ingredient alone, natural gas prices, will that give the cooks what they need to serve as a cold meal tomorrow, a lower CPI reading, we'll see. I doubt it because we have other items like food prices and used car prices, etc., etc. Back to the CPI, when we look at the readings here for items the likes of window coverings, up 1.8% month over month. Even bedroom furniture up 1.3% month over month. Clocks, lamps, decor up 1.8%. And even flowers, indoor plants and flowers up 1.5% month over month. So if your significant other comes to you and says, honey, how come you stopped being romantic? You say, it's not me, it's Jerome Powell, it's inflation. Blame him. Flower prices are insane. Although flowers is a guaranteed way, always a guaranteed way to get laid. But anyways, what about tools prices? Tools, hardware up 3.2% month over month. And then we have household paper products, also 1% month over month. Men's underwear, who needs that, right? 1.3% month over month, and that inflation will go higher, a lot higher, once the crypto crash happens. You're gonna need a lot of underwear. So get them now while they're still cheap. When it comes to women apparel, it's absolutely insane. Whether we're talking about outerwear, dresses, suits, all significantly higher month over month. Most notably, of course, is women underwear. That's up 3.4%. Also a gift that could either get you laid or kicked out of the house, specifically if you get the wrong size. Anyways, even infants and toddlers apparel also up 1.1% month over month. When we talk about transportation, this is important for used and new cars and trucks prices. When we talk about new cars and trucks, this is up 1.4% month over month. Used cars and trucks up 2.6% month over month. Even tires, because rubber prices are surging out of whack. Tires up 1.2% month over month and a stunning 9.2% year over year. When we talk about oil, coolant, fluids, that's up 2.1% month over month and a stunning 11% year over year. Non-prescription drugs up 1% month over month. Audio equipment up 2.4%. When we talk about sporting goods like bicycles up 1.9% and sports equipment's up 1%. Even computer software is up 3.3%. But notice smartphone prices are down 3.3% month over month. What does that mean? When we talk about companies and stocks that can withstand this inflation, are you better off with software companies or hardware companies, meaning Microsoft or Apple, for example? I'd go with the software because this is a proof. These companies have the pricing power and they're exercising the pricing power by rising prices higher. Case in point, Microsoft is jacking prices higher for customers. On the other hand, Apple with the smartphones is going to have limitations on how much they can increase prices when smartphone prices are going down. And what about the good stuff? Alcoholic beverages, well, they're down month over month. It can damage your liver cheaply, but if you want to damage your lungs, well, that's going to cost you an arm and a leg because tobacco prices are surging higher and the inflation was 2% month over month. What about items like gift wrap? Well, that's also up 3.5% month over month, but that could be seasonal, of course. It makes sense. The problem is prices of gift wrap is also up year over year by over 8%. Now, what about gardening? That's up 1.1%. Therefore, Home Depot, Lowe's, these are some of the best performing stocks as of late. Likewise, what about health insurance? That's up 2%. So much for affordable health care, right, Joe? And of course, health insurance companies, the stocks of health insurance companies, the likes of UNH, United Health, these stocks are also performing beautifully as of late. And this is an important one, rental prices for cars and trucks. That's up 3% month over month and a stunning 39% year over year. Maintenance, repair, that's up 1.5% month over month. Public transportations, airline fares, they were down. Now they're up again. 3.5% month over month. Video discs and media up 2.8%, and then we have recreation services up 1.6%. Now, what if you want to join a cult? For clubs, admission prices are up 3.2%, and then admission to sporting events up 8.3% month over month. Insane. Postage prices up 4.2%. And then I have a mistake here in highlighting, but legal services are up 1.8% if you need a lawyer, and then dry cleaning up 1% month over month, and financial services up 1.4%. So you get the picture here. Inflation is now endemic. Inflation is spread all over the economy. It's not just reopening factors or transitory crap. It is all over the place now. And if that wasn't enough, we have even more bad news for Jerome Powell. Weekly jobless claims fall to 184,000, the lowest level in more than 52 years. If this is not maximum employment, Mr. Powell, then what is? Powell says I have the substantial further progress bullshit test before I raise interest rates higher. I need to see maximum employment. Well, this is maximum employment, Mr. Powell. And oh, by the way, your wages are surging higher. And I told you, they're going to tolerate equity prices inflation, real estate inflation, gasoline inflation, everything else inflation. But if inflation touches your wages and your wages start to go higher, gonna end the party, Mr. Powell, because God forbid the oligarchs have to pay a little more. And the problem is, yes, wages are rising higher and they're benefiting the poor, the bottom 25% of earners. Here's the problem. If we don't stop right now, inflation will eat away all of your wage gains. Whatever dollar you get extra in wages, you're going to pay $3 more in rent. We get another piece of data. U.S. household net worth is at all-time high, even though posting a smaller gain in this so-called COVID recovery. The problem is, you lump me, Bezos, and Musk, and we're richer than ever. You take Musk and Bezos out of the equation, and the picture looks drastically different. And by the way, out of all this so-called wealth, the top 1% owns the most, and the bottom 50, they're not even on the radar. The majority of wealth was created for the top earners, the oligarch class. Thank you to the Federal Reserve and the genius financial engineering of the system. But you know why Jerome Powell is panicking right now and being a hawk? Because we, the population, we can tolerate gas inflation, we can tolerate rent inflation, we can certainly tolerate wage inflation. But if you come after our pizza, that's the red line. The revolution starts right now, today. Bring out the guillotines. And guess what? Pizza prices are surging higher. Matter of fact, no more 99-cent pizza. Why Washington is getting worried about inflation, and this is from the New York Times. Price gains have moved up sharply for months, but the fact that the trend is lasting and broadening has newly put policymakers on red alert. That's it, folks. That's the red line right here and then. When pizza prices go higher, the revolution starts. And your beloved politicians are now getting sweaty. No more 99 cents pizza. We have to cover that. It's $1.50 pizza right now. And oh, by the way, the crushed pepper and Parmesan, that's 50 cents extra. And another item that we're going to watch closely tomorrow is used car prices, because remember when they said this is transitory, the reopening impacts, and then used car prices are going to go down anyways. Well, guess what? They continue to go higher and higher and higher. So what's going on with Team Transitory? You still alive? Well, they're dead, as Bill Gates would say.
Well, he's dead, so...
Even the Fed retired Transitory. But you can believe Mama Kathy, Tesla witch Kathy Wood, who says demand destruction in the used car space, especially given the increased preference for electric vehicles, is likely to cause a serious problem in the auto debt credit markets. During 08-09, auto credits held up better than any others. This time will be different. And you know, Kathy Wood has a talent of making herself look smart when she actually knows nothing. And she is referencing the Manheim Used Car Price Index, because sales were down 2% year over year, yet prices went higher. And here was somebody who responded to Mama Kathy, and he said, "Your remarks regarding used vehicle sales show you're out of touch with the market. If you are so out of touch with this simple metric, one has to wonder about your investments. I have been an auto dealer, second generation business since 1950. Used car sales are stronger, maybe that's what he meant, right? Stronger than they have ever been. Hence the MMR reports going through the roof. Sales numbers are down slightly simply due to the lack of inventory. Bingo! Huge lack of inventory. There is no EV demand." And here is the obituary for the transitory crap, just in case if somebody out there still believes that inflation is due to the reopening and transitory crap. Well, here it is. The reopening in pink, energy in yellow, and black the non-reopening components of the CPI. You see, the pink, the reopening components, went down in August due to the rise of the D variant, but black and yellow continued to go higher and higher and higher. And guess what? The reopening components, they're also back in positive territory again. What does that mean? Inflation was never transitory. Inflation was never due to the reopening crap. The real reason from the get-go was the cocaine from the Fed. You want to print more to make the rich richer, an overstimulated economy that doesn't need stimulation. Well, you're gonna get inflation, baby. COVID or no COVID, reopening or reclosing, lockdowns or metaverse living, doesn't matter. You print more, you stimulate an economy that doesn't need stimulation, you're going to have inflation. And this is causing the Biden White House a dire cost. as the majority of Americans now believe that the economy is heading to the wrong direction. The economy is in the wrong track. We haven't seen such readings, by the way, since the aftermath of the financial crisis. And inflation expectations are surging higher, and they're coming hand in hand with tightening expectations by the Fed. This chart explains the odds, the probability that the Fed will raise interest rates by June 15th. Those probabilities are now reaching the highest reading so far, meaning we have conviction right now the Fed will indeed tighten. Because inflation is all over the place, it's no longer transitory. It was never transitory, and it was never due to reopening reasons. The problem is the Fed is too late to the game, so they have to be too aggressive now. And by being too aggressive, they end the party in the stock and real estate markets. And after this whole inflation story is gone, the rich ends up being the winner, and the average folks end up being losers. Thank you to the clueless moron at the Federal Reserve. And with that out of the way, let's move on to the market's coverage, starting with the performance. And here we go. The Dow Industrial Average flat, doing nothing at all. I like flat so long as she got ass. Anyways, what about the Nasdaq? In the red, down 269.62 points, or a decline of 1.71%. The S&P 500 also down by 33.76 points, or a decline of 0.72%. What about the sector's performance today? Abysmal, awful across the board, no metals at all. We're going to shame some names here because the decliners were led by cyclicals, technology, and REITs. What about the advance to decline ratios? The NYSE 22% advancing versus 76% declining. The Nasdaq also 22% advancing versus 75% declining. Now, you and I know when we have exaggerated ratios to the downside or the upside, you're going to spring back to the flat line. The problem is we have the CPI release. That will complicate things. Thus, the mechanics of the market versus the fundamentals. Moving on to commodities, futures. What's going on here? Crude oil futures are down by about 2.5% apiece for the WTI and Brent. Likewise, gasoline is down, heating oil is down, natural gas is also down. Muted activities here for softs, at least for cocoa and cotton. We have declines for coffee and sugar. They go hand in hand, while we have modest gains for OJ, and the silent rally in lumber goes on. We have now crossed the 1,000 line. When will the media start talking about lumber? What about metals? Declines across the board. Massive ones for silver, platinum, copper, palladium, all down. Likewise, gold is down, be it modestly. What about meats? Live cattle futures are down by a little over 0.5%, while feeder cattle futures gaining modestly. On the other hand, lean hogs futures, back from the dead, rising higher by over 2% today, almost 2.5%. What about grains? Mixed picture here. We have gains for soybeans, soybean meal, and corn futures, while rough rice and canola on the flat line. And then we have losses led by wheat, oats, and soybean oil. And over the weekend, we're going to go over charts for these futures and commodities because we have technical developments in a lot of charts, perhaps a topping formation for both wheat and oats. Moving on to the big casino, the options market. What's going on here? The hottest table by far remains Apple, with about 2.5 million contracts exchanging hands today. About 64.5% of those were calls. And at number 2, Tesla, the souffle, with almost 1 million contracts. About 53.5% of those were calls. And at number 3, AMD, with a little over 500,000 contracts. About 63% of those were calls. Moving on to the unusual activities that took place in the options market today. What's going on here? How about the ticker KR for Kroger, a stock that I own in my portfolio, and it performs in good times and in bad times. In this case, they're buying calls, the 46 calls for the expiration date, December 23rd, with the expectations that the name could pop higher by more than 5% by then. They paid about 30 cents a piece to enter this trade, all in all spending about $300,000. What about the trade for the ticker IWM, the Russell 2000? They're buying calls here, surprisingly of course, the 234 calls for the expiration date, New Year Eve, December 31st. With the expectations that the name could pop higher by more than 6% by then, they paid about 90 cents a piece to enter this trade, all in all spending about $600,000. And what about the trade for the ticker BHG? This is for Bright Health. The name popped higher today. Mind you, it's down big year to date, but they're betting on more short covering here. by buying the $5 calls for the expiration date January 21st with the expectations the name could pop higher by more than 15% by then. They paid about 70 cents apiece to enter this trade, all in all spending about $385,000. And then we have the trades, not one trade but two, for UNG, and this is for US natural gas. This is a strangle trade, meaning they're not sure whether natural gas prices will pop higher or crash, but they're sure that there is a massive move coming, and therefore they're buying the $14 calls, and they're also buying the $10 calls for the expiration date of February 18th. They spent about $1 a piece for the calls, and they received about 40 cents a piece for the puts, All in all, spending about $350,000 on this trade, perhaps betting that something is going to happen with Russia and Ukraine. Natural gas prices will go crazy one way or the other. And what about the trade for the ticker SNAP Snapchat? They're buying a lot of calls here. This is one of them. The 60 calls for the expiration date, December 31st, with the expectations that SNAP could pop higher by more than 14% by then. They paid about 70 cents apiece to enter this trade, all in all spending about $350,000. What about DOCU DocuSign betting on a rebound here by buying the 165 calls for the expiration date December 17th with the expectations that the name could pop higher by more than 10% by then. They paid about $1.80 apiece to enter this trade, all in all spending about $900,000. What about the ticker LCID for Lucid Motors? Down big today, and the reason is they're dumping more shares. They're raising a lot of money. You see, here's what the retail crowd doesn't understand. When you pump stocks higher beyond their reasonable valuations, specifically these upstart companies, they're going to seize the opportunity by dumping shares on your little head. So if you believe that Lucid is going to be the next Tesla bro, and it deserves to be at $75 billion valuation when they barely have a product, you're insane, and you deserve to be dumped on. But anyways, somebody's betting for a rebound here by buying the 42 calls for the expiration date December 17th. With the expectations that LCID could rebound higher by more than 15% by then. They paid about $1 a piece to enter this trade, all in all spending about $500,000. And lastly, what about the trade for the ticker ARKKKKRKGOS 2.0? They're buying puts here aggressively. The shorts are heading Mama Kathy left and right. In this case, they're buying the 90 puts for the expiration date January 21st, with the expectations that RKKK can go down by more than 8% by then. They paid about $3.75 a piece to enter this trade, all in all spending about $1.5 million. Moving on to the heat map analysis. What's going on here? A bloodbath, specifically in the northern side of this map, meaning technology, cyclicals, etc. What's working here? Some banks, Bank of America, we have CVS, which had specific news, Pfizer, AbbVie, some value names outperforming. But notice how quickly the rebound in oversold names was reversed. PayPal, CrowdStrike, RKK, a lot of names that rebounded higher on oversold bases are giving back a lot of the gains. Why? Because I told you in this channel, us traders are behind those oversold bounces. We buy them because they're oversold and we dump them right away. In, out, hello, goodbye. Quick profit. When you have this kind of mentality leading the rebound higher, it is not sustainable because traders have an entry strategy and an exit strategy, and sometimes that's quickly fast. When the thesis is, I'm betting on a rebound from oversold bases, and that's all there is. Who's going to follow up and do the buying? If there is no follow-up, the gains fade out quickly. Moving on to charts, starting with the SPY, 30 minutes chart. What's going on here? Not a good looking chart right now, yet the SPY did not lose the support of 466, unlike other charts that we're about to go and visit. So what does that mean? It is a process of waiting. We sold the market off, we rebounded it higher again, and now we're waiting for the CPI and the implications of the reading on the Fed's policy. We're going to start to panic if 466 is broken, then we have 461, that's the next support, and after that you close the gap and you flush down. You'll make a lower low. On the other hand, if the SPY keeps 466 as support, regardless of the CPI reading, then we have all-time highs once again. And here is the daily chart for the continuous contract for the SPY. Some give back here, as we anticipated by the way, some de-risking ahead of the number, the big number, the data, but we have yet to give back 4,657, and we are far above 4,549.5. And therefore, the chart continues to favor the bulls, although the volume is moving higher again on the downside. That's number one. Number two, what is your leading indicator here? The answer is the RSI. The lagging one, the one you use to confirm things, is the MACD. The leading indicator, the RSI, is curling down slightly. With that result, in a failure to cross in the MACD indicator, and if that happens, then we have an ominous signal, perhaps one of the strongest bearish signals. But until then, the chart remains favorable to the bulls. What about the Qs? Different story here. You lost the support of 397, and therefore comfortably we can take out the bull flag out of the picture. Now we have the gap, we have the support zone, we have a lot of targets here if the Qs continue to flush down. But notice this, the regular hours trading activities, the pop in the Qs is almost gone, and we only have the overnight manipulation by the thieves. That's all there is. But the market did not stand on its own feet. They painted the tape, they pushed the Qs higher, and there was no follow-up. This is not a good look for the chart psychologically speaking. And what about the daily chart for the continuous contract in the Qs? What's going on here? Again, the volume is rising higher on a down day. The RSI is curling down, so is the MACD, by the way. Not a good look for now, but the bulls can breathe a sigh of relief that they're keeping 15,976 for support, at least for now. The problem is, you look at the pattern, it was a head and shoulder formation, not a clean one. But if we go down again and pierce below 15,976, then we've only made a cleaner head and shoulder formation, and therefore the bull trap. What about the IWM? What's going on here? Not a good look either. No bull flag here. We're going to take that out because the chart went down and it lost the support of 223. Now we have the gap at 219.40. If that doesn't work, then we have the support at 218. But boy, it's not good to give up here. You had all the energy in the IWM to push higher, perhaps recapturing support at 229, even closing the gap. But giving all of these gains quickly is not a good sign for the Russell 2000. And you and I know, looking at the weekly charts, when you have a fake breakout higher from consolidation range, the likelihood is that energy will be released to the downside. The IWM doesn't look good anymore. What about the Dixie, the dollar? What's going on here? We still have a bear flag formation, but Tricky Dixie continues to hold on at 96 for support. And the reason is, it is waiting and waiting and waiting for the CPI and how the Fed will react to the reading. It is really hard to predict how the Dixie will react because tapering in essence is tightening, and that is favorable, meaning bullish for the dollar. But what if we have sell the news, meaning we get a hotter CPI reading and we know for sure the Fed will taper, perhaps ending all purchasing programs this month? What if we have sell the news and the dollar goes down? And therefore, you cannot trade gold right now. You cannot do anything at all. It continues to hold above 1,763, but until we have clarity regarding the dollar, you cannot do anything here. I'm starting to like gold a little more, perhaps as we tighten and the market doesn't look attractive at all anymore. The bond bubble goes bust. Maybe gold will be attractive again, but I gotta wait and see how the US dollar is gonna behave. And here's another important chart for gold, the US 10-year Treasury yield. And all eyes will be on this chart, by the way, after the CPI reading. We have a slight pullback here, giving away 1.5% for support. I want you to remember this, by the way. As Powell became a hawk and started talking about aggressively tapering and tightening, the yields on the 10-year went down and the yield on the 2-year went higher. What does that mean? Flattening of the yield curve. As if the bond market is saying, Mr. Powell, if you tighten as you're planning to do so, you're going to push the economy into a recession. There is a rule in the market that says always trust the bond market, but historically speaking, we have seen the bond market throwing fits. What if the action of buying bonds aggressively, therefore pushing prices higher and yields down in the 10-year, is basically another fit? Another hissy fit by the bond market to warn Powell. But what if Powell doesn't budge? And Powell says, you know what? I'm going to taper either way. I don't care what you guys say. Then will the bond market come to its senses and say, you know what? Mechanically speaking, we cannot substitute over $80 billion worth of bond purchases a month by the Fed. Who's going to substitute the sugar daddy? So mechanically speaking, when the Fed tightens and stops buying bonds, yields should shoot up higher. And maybe bond investors at that point will give up and we will see the 10-year yield shooting up higher again. We'll see. Therefore, I continue to say that this will be the most important chart to watch tomorrow. And here's the chart for the TLT, a weekly chart. What's going on here? We're now giving away the 149. Almost. The weekly closing will be decisive. A closing below 149, it's over and done. We're not going to talk about the TLT anymore. It's trash. It's going to crash. A closing above 149 decisively will keep the debate alive that perhaps the TLT will go higher, 10-year will go down. What about the VIX 4 hours chart? What's going on here? Look at the MACD indicator. It went down, creating red impressions on the histogram. That was right away, right there and then, the sign that the VIX has stopped and SPY will pop higher. What are you seeing right now? A saucer bottoming formation on the MACD. Those red columns are getting shorter and shorter and shorter, meaning perhaps we're about to have a crossing again to positive territory, creating green impressions in the histogram, which will translate in another double-digit pop for the VIX. But look at where that pop will originate from. Not from 15, not from 16, but from 20, which happens to be a higher low, something that we haven't seen in the VIX since last year, which means that the next pop could be epic in nature. And of course, keeping 20 as support is a massive win for the bears. Market bears, that is. I was looking at the 5 minutes chart today, and I saw the VIX revisiting 20 over and over and over again, and reconfirming that for support. And immediately I tweeted, the Qs is losing support at 397. IWM is also losing support at 218, but the VIX is keeping support at 20. You put 2 and 2 together, and the declines by the end of the day for the market was not surprising at all. And here's the daily chart for Apple. What's going on here? It continues to hold on, impressively so, but is this a topping formation? I would argue it is. Absent of a surprise in the CPI, the bet here is that Apple will go down. It is already overextended on the MACD and the RSI. We have a topping candle, a shooting star. What more do you need? Perhaps the manipulation via options is over and reality is going to hit, absent of the cooks giving us a cold CPI reading. And the pullback target for Apple is closing the gap, which will be around 5% declines from this point on. What about a daily chart for Tesla, the souffle? It didn't even make it to 1,090.5. It didn't even happen. This is a bearish signal, not a bullish one. And the name is trading below 1,000 after hours. What does that mean? We could see an epic down day tomorrow because we have at least, when you look at the options grid, we have at least 25 million puts at the 950 and about 15 million puts at the 1,000 mark. What does that mean? If Tesla opens to the downside, you're going to see a lot of hedging by market makers. We're going to dump Tesla like crazy. But this is all depends on the CPI. If the market flushes down altogether, the assumption is Tesla will flush down, and it will be an epic day to the downside if the reverse gamma squeeze happens. And to put it in perspective, here's a weekly chart for Tesla. Not looking good right here. The MACD is curling down, the RSI in negative divergence, and if Tesla goes down to the trend line, still keeping the bullish trend line by the way, top to bottom it will be about 37.5% correction. We'll take it from there. Moving on to tulips, what's going on with BTC, Bitcoin? The bear flag is playing out. You gotta wait here. It's too dangerous to buy anything here on BTC. You gotta wait till 42,000. The bottom was 42,333 for that massive candle to the downside over the weekend. You gotta wait for the double bottom. I don't like it here. I think we will see more pain to come on BTC. And by the way, about 50% of US Bitcoin holders bought BTC during this year. We're far above the year-to-date number, which is around 11,000. So we're not seeing mass hysteria here. We're not seeing mass liquidation and panic. But there is a magic number here that's going to put at least 50% of those 50% underwater. And when that number is hit, you're going to see margin calls and the domino effect selling taking place. And then BTC crashes. What is that number? I have no clue at all. And what about AMC? What's going on here? Not a good day for apes. The bull flag did not work out, and AMC has breached the support of 32 once again. Perhaps the negativity from GME GameStop was contagious today, but boy, this is not looking good. If you lose 26, it's going to be tough to come back. And that's that. The message for apes is you gotta defend 26 once again. You cannot lose 26, otherwise the reverse gamma will happen and you can go down to 15, even 10 on AMC. And remember, those put options contracts for the 25 puts, that is for the expiration date of December 17th, meaning next week. So you gotta continue to hold and continue to fight back. But if 26 is over, you're toast. Abandon and get the hell out of AMC before you lose more money. And lastly, we have a viewer, and apologies of course for not quoting your comment directly, but you know who you are. You asked me about Edwards Life Sciences. We talked about this chart before. Take a listen. What about the ticker EW, Edward Life Sciences? This is a stock that I own in my portfolio, but I got rid of the entire position today. Why? We have a topping formation in the MACD and RSI perspective, and even from a candlestick pattern. You see the candlestick that I'm highlighting? What is that pattern? This is your homework, by the way. Let me know in the comments. What is this pattern called? It is a topping pattern, and now we have the confirmation, and therefore I got rid of the position, even though it's an excellent company, and I will buy the dip if the stock goes down 10, 15, even 20% in a massive correction scenario. So what's going on here? Obviously, the chart did not go down 10, 15, or 20% from that point on, but it went down top to bottom by about 14%. And then it reversed back, forming the double bottom, and this is a positive technical pattern. The problem is, would you buy right now with all what's going on in the market? This is an excellent company, by the way. But the valuations don't make sense to me anymore. I bought it in the beginning of the year and it made sense back then. Right now, it's hard to stomach. So if you want to buy this one, you got to buy it via call options, meaning buy the 130 calls for January or February. That way, if the stock flushes down, you only lose your premiums in the call options. But if the stock makes it, and let's say it trades on 130, 140, 150 by February, you can exercise your options and own the stock in a safer, a more disciplined way than just buying the stock right away. It's an excellent company, the leading innovator in cardiology, and this will not stop, but I would rather have it at a better valuation than what it's trading right now. The technicals are positive, the double bottom, you can't fight that, but if we're about to tighten, depending on the CPI tomorrow, you don't want to buy it right here with this valuation. So using a call option strategy is a safer way to bet on this name. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? Just in case you weren't listening or paying attention, we have the CPI, aka the CPI. And the cooks are gonna be busy in the morning. Busy doing what? Busy cooking a cold meal, downplaying the true nature of inflation. Why? So Powell can back off and the stock market blast higher again. We'll see. Then we have the University of Michigan sentiment, consumer sentiment that is, and this will also be important. But all eyes will be in the CPI, an important day tomorrow. I'm not going to keep you here for any longer. This is all I got for you for now. Thank you for listening. Thank you for watching, and I will talk to you again over the weekend.